The private market encompasses assets that are not publicly traded on stock exchanges. These include private equity, or PE, and private credit, where companies borrow from non-bank lenders. Private assets require a minimum holding period of around 5 years, which can go up to decades. In the longer term, private assets can yield higher returns than publicly traded investments such as stocks and bonds. The return usually includes what is called the liquidity premium, meaning private assets offer higher returns to compensate for the lack of liquidity. That's because when they are private, such assets are not traded with the frequency and volatility of public markets. And you don't need to cough up millions of dollars. Recently, global investment firms Capital Group and KKR launched 2 private market funds where the minimum investment amount is $1,000. Such investments could prove attractive, particularly in Singapore, where in recent years, more companies are going private instead of public. But as with all investments, there are caveats. Private market funds can also be subjected to higher fees than mutual funds managing stocks and bonds. That's because the GPs need to put in extra effort to source for new deals and exit existing ones. GPs also collect performance or incentive fees, known as carried interest, which investors will pay when the fund yields returns that exceed a certain amount. All these fees are usually on top of those levied by digital platforms which accredited investors use to subscribe to the fund. So what else should retail investors consider if the private market is open to them? Read my stories on the Business Times to keep up to date on the latest in private equity and wealth.